This is a joint presentation of PHP Intellect and IITLA, and I'll give you a little bit of an introduction to both. PHP Intellect is a full-service IP consulting and engineering services firm with a growing cadre of hundreds of experts in various technology and scientific fields. It was founded by industry veterans and accomplished innovators. It is led by strong and diversified management and advisory teams whose decades of experience, technology, and science expertise and industry connections are leveraged to help IT companies, high-tech corporations, and law firms achieve their goals. You can visit us at ghpintellect.com. IITLA is International Intellectual Property Law Association. It's a network of IP professionals fostering collaboration as well as innovation in developing countries. Annual meetings are held in San Francisco, in Europe, as well as Dubai. It provides webinars and other events. There's a meeting in Brussels coming up soon. You can see more about it or read more about it at iipla.org. We have a very distinguished presenter today to talk about IP valuation fundamentals. Dr. Masoud Vakili is the Chief Strategy Officer at PHP Intellect, as well as one of the founders and the director of IITLA. Dr. Vakili has over 2 decades of experience in the field of IP development, management, valuation, acquisition, sales, and licensing. Throughout his career, he's been involved in many high-profile IP transactions. He's led the valuation of 50,000 patents per year, dealing with hundreds of millions of dollars in patent sales and acquisition transactions. And among his achievements is the critical role he played in the sale of Eastman Kodak's patent portfolio worth $500 million. He's also participated in consortium building, rights division, and asset collaboration and allocation in sophisticated IP transactions. Moreover, he's been an advisor to several startups where he's helped develop their IP portfolios towards successful IP monetization programs, culminating in the profitability and acquisition of the companies. As I mentioned, he's a co-founder of IITLA, and he's been an invited speaker at U.S. Patent and Trademark Office. He's given many keynote speeches on subjects related to the IP market and IP valuation principles. He's a named inventor on a dozen filed patents and has published dozens of refereed articles in technical and scientific journals. He's probably evaluated more patents than anyone else on this planet. And he ran a team of 10 valuation managers in the past, and his talk is currently about valuation methods. A quick note about the presentation format. It's going to be a 30-minute talk and presentation by Dr. Vakili, followed by question and answers. Questions can be received throughout the presentation, but will be answered at the end. A link to download the slide deck will be given at the end of the presentation as well. So without further ado, I'd like to request that Dr. Vakili introduce himself a little bit and begin the presentation.
Thank you, Bob, and thank you, everybody. Good morning, good afternoon, good evening, depending on where you are. So I've met many of you. My name is Masoud Vakili, and I'm going to talk about patent portfolio valuation, and it's the art that everybody needs to maybe deal with it at some point. So here we talk about the importance of IP, and in many cases, IP is very important in fundraising for early startups and even round 2 and other rounds. It definitely produces good leverage in business transactions. People will feel comfortable. Many of the companies that we advise and we develop portfolios for them, it gives them confidence to do business, and their clients feel confidence doing business with them. As to indemnification, it's definitely crucial for exit strategy, be it IPO or being acquired by a larger company. In mergers and acquisitions, it plays a huge role, and I'll explain. And it definitely plays an important role in freedom to operate, which we'll talk about a little bit. And we'll talk about how IP transactions have become a market of their own. So let's talk about IP valuation a little bit. It's a perennial question. What is a patent? How much is a patent worth? And the applications, like I said, are in mergers and acquisitions. The value of a company is hugely affected by their patent portfolio, and it manifests through something called a discount rate, which lands between 10 to 30%. Normally, I've seen transactions in which a company is being acquired, has a good patent portfolio, and the discount rate ends at around 10%, and without the good portfolio, it lands closer to 30%. This will amount to an order of magnitude in valuation. So I've seen companies acquired for $200 million, and with good portfolio, they're acquired for $2 billion. So it's a huge difference. Definitely an IPO, a successful IPO depends on a good portfolio. You've seen Kramer probably talk about successful IPOs and the role of a strong IP portfolio. And in cross-licensing, it definitely plays a huge role. One example of this is the licensing of AMD patents to Intel for about $1 billion, just a few years ago. So in investments and fundraising, many of startups come to us and say, we're going to investors. If you go talk to anybody on Sand Hill Road here in Silicon Valley, they ask do you have a patent or do you have patent applications. So it's very important to have a patent applications, strong portfolio. In a strategic partnership, if, for example, you're a biotech, you want to have a strategic investment from somebody like Roche, they'll look at your FTO. If you have relative FTO and good patent portfolio, they'll be very happy to invest and partner. Otherwise, I've seen many big companies shy away from startups or smaller companies that don't have a strong patent portfolio. And portfolio sales have become a market in their own rights, and many people bid on existing portfolios, including direct bidding or bidding through a proxy, in which case you don't know the seller and the buyer doesn't know the seller, and vice versa until the transaction is complete. Many examples of that is Eastman Kodak, Motorola Mobility, and Nortel. I'll explain a little bit about these later. And in liquidation, liquidation definitely is affected by IP portfolio. One perennial example is Nortel IP portfolio value was greater than the company when they liquidated at $4.5 billion. So what is the philosophy of patents and assets as their own markets? And they have grown from being honorary to all-out financial assets. They have created their own markets, but they have been around for more than a century. I'll give some examples of this. And this is nothing but really an abstraction of value. And in abstraction of value, I explain what it is. Generally speaking, since a long time ago, the less people know about what you're doing, the better off you are. So, like for example, in old times, a merchant always did better than a farmer or a blacksmith. They use more sophisticated methods. They're more hidden, and more profitable. They're scalable. You could scale your operations, but it also comes with risk, so it's riskier. So my next slide shows how commoditization hierarchy has to do with it. So constantly we see old markets being commoditized and replaced by new markets. Let's go 50 years back and you see a chip being made, and IBM comes and says, okay, the chip is excellent, the semiconductor, but I build a box around it, I make a computer, and that's the real value. Then somebody like Microsoft comes about and says, okay, this box is excellent, but the brain is the software, so without the software you can't do anything with it. So see, just like the chip was commoditized, now the system, the computer, the laptop is commoditized, and the software has the first word. And then somebody like Google comes about and says, oh, the software is great, but I give it to you for free. I give you spreadsheets, presentations, documents, I give you Drive to save your file, I give you even the file system, everything. But what is important is the intelligence, the ads, the services. So we see that the software being commoditized. So this inevitably gives rise to NPs, non-practicing entities, coming and saying, okay, ads and services is great, software is great, chips are great, systems are great, but it's really the idea, the patent, that counts. So it is inevitable, it comes about, and its abstraction to the ultimate level, which is the idea level. And in today's world, everybody is trying to commoditize everyone else. And that's the idea behind vertical integration. Everybody is trying to vertically integrate. For example, look at Amazon. Amazon has a good e-commerce platform, but they also have S3, the storage system, and the elastic computing, but they do have the web services on top of that. So the name of the game is commoditize yourself before somebody else commoditizes you. So see all these big companies, they have their own hardware devices, they have their own clouds, they have their own software, they have pretty much everything in e-commerce. They try to do their own e-commerce, be it through songs or just detergents. So anything is for sale, from Apple to Google to Amazon, and then Microsoft. All the big guys are in there. So here's an example from 150 years ago. This is a guy that you don't know. Probably his name is, this is the patent, is a light bulb. And this is a guy that you do know. The guy on the left, his name is Henry. Let's see if the guy on the right, everybody knows, is Thomas Edison. He bought this patent 150 years ago and added it to his portfolio of patents. The guy on the left was a Canadian medical student, and he actually was the inventor of this patent. This is one of the examples of very early patent sales. 150 years ago switched to 75 years ago. This lady is credited to be probably the most beautiful inventor of all times. Her name is Hedy Lamarr. Hollywood actress, came from Austria, but he's also the co-inventor of frequency hopping. And this is the basis of all today's communication systems. And he eventually sold his patent about 75 years ago to Bell Labs. So you see that this is this market has been around for a while. Now that we know that patents have value and they're for sale, and the question is, how do we estimate the value of a patent? And the answer to that is there are three fundamental methods for patent valuation. One is cost-based. The cost-based method basically tells you how much is a patent worth. So basically it is how much did it cost for this patent to be generated. And these costs are R&D costs, legal costs, and fees. And basically if you add them up, they roughly amount to 50K plus, so per patent. So if you're interested to obtain a patent, you cannot pay less than 50K basically. The next method is market-based, and the market-based is just a like for like or comparable. So you go to the market, you find a transaction, IP transaction that took place, and you'll say, okay, this took so much to buy this patent, and somebody paid so much, and I have a similar patent, and I'm going to ask for a similar amount. And it's really dictated a lot by the ask price. You have to be careful if the patent is a referral to a technology or is a core technological patent. And then based on this, you end up anywhere from 50K, which is in agreement with your cost-based evaluation, all the way to $250,000 and above for really core patents. Next are income-based, and this is really the most utilized method. It's basically a discounted cash flow model. And it's based on, okay, how much money can I make if I obtain this patent portfolio? Or how much would it cost me if I didn't do it, if you're a practicing entity? And it really depends on what you plan to do with it. So let's go to each one of these one by one. The first one was cost-based valuation. There are several costs here. It's basically generate, file, and maintain a patent. It includes R&D costs. These are tremendously difficult to estimate because there's no real log for them, and it's basically the cost of the development of the technology and then innovation. It's a hidden cost, and it's not obvious, like I said. It's easy to justify. So if you are an executive, and somebody tells you this is the R&D cost, they say, okay, that's fine. And there are legal fees. These are attorney fees or law office fees. These could really add up and includes drafting, filing, prosecution, and maintenance. It could really add up if you go international, including translations and foreign associates. Difficult to justify if you're an in-house person. Try to justify this to your higher management. It's really difficult. The PTO fees are more reasonable. They could really add up too if you go internationally, but they're also easy to justify because they're fixed. They're not really variable. Especially if you want to defer costs. If you're a small entity, you could definitely do a US provisional patent and file a PCT on top of that. Keeps the costs at bay for about 30 months. That's what most people do. So the bottom line is 50K per patent. That's if you have only one thing to take away from this talk is if you are interested in a patent, it's really a 50K minimum. And this is a 50K rule. But in reality, regardless of how much it costs, it could be zero, or it could be millions of dollars, and we'll go into these. Next method is market-based valuation. This method tries to use a like-for-like analysis for patent prices. It works very well for large patent portfolios, and I explain why. But it's very tricky for small patent portfolios. So, like if you have one patent that was sold for 100K or 200K, and you come back and say, okay, this is a similar patent, and I'm going to sell this for a similar amount, that's really hard to do because of several factors which I'll explain. Like I said, this works very well for tangible assets, and a good example of this is real estate. Two houses in the same neighborhood, similar condition, age, they probably have comparable values. The problem is it's not directly applicable to patent valuation, because if you have two very similar patents chances are one of them is invalid. So it just breaks down right there. But in the next slide, I'll go into what you could do for small portfolios to leverage this method. We said it works well for large patent portfolios. One example of this that's very dear to all of us is the sale of Nortel LTE portfolio, which was sold to Rockstar for $4.5 billion a few years back. And a similar portfolio was the Motorola Mobility LTE portfolio. Google acquired the whole company for $12.4 billion and spent it out for $3 billion, got some cash, and ended up at $5.5 billion. You see the comparables for these two large portfolios, same nature, same period of time, really works well. And this is the details of how this $5.5 billion came to be. Other examples of this are the sale of Eastman Kodak, which I was involved in the valuation, AOL to Facebook, AMD to Nortel. And these are all about $1 billion line. Now, how could we use this for small patent portfolios? There are a bunch of checks and balances that we could use. I go into them one by one. As we know, they're risky. There are all these jeopardies today, especially 101 issues that they could knock out a single patent. But there are measures we could take to mitigate these risks. First thing that you should do, in my mind, is check the validity. Then you identify a read on a product or a feature, and you identify how core that feature is to the product. One example of this, if you have a cell phone or a mobile device, the battery is a core technology, or the flash memory is a core technology, whereas the application per se is not core so much, an application that comes in the box. Then you find a similar patent if you have a core technology, like you could, for example, compare a patent on a battery to a patent on flash memory. That's fine. And you go and look into recent transactions. Some of them are published. Some of them people just know about them. And if the core features are a little different, you could do a little bit of modeling, which I'll show in our income-based. And based on that, you estimate your market-based valuation. So basically, find out your patent is valid, find out what it reads on, how core is it, find a similar transaction in the past that it was a similarly core technology, do some modeling, and basically estimate your market-based valuation. In a nutshell, that's how you could do and justify market-based valuation for small portfolios. For large portfolios, like I said, you do have a lot of leverage, and it does come easier. Finally, what you could do here is to assess risks and use that as a discount factor. Now, the discount factor comes in several forms. One is a discount, upfront discount, and one is the discount rate, which I'll explain later. All right, so this is market-based valuation in a nutshell. Next, we go to income-based valuation. And this is really what most of my valuation life I've used income-based, because this is really what is solid and what people like to see. If you have a patent, you want to acquire it, what is it that you want to do with it, and how much value does it bring to you? For a practicing entity, it's just what it is, it's a business cost of not owning or not having a license to patent. So basically, if you are Google and you have looking at a patent that's related to search or related to maps or related to Street View, this is something that, in my mind, Google would try to pick up at good price. For non-practicing entities, if you're buying this and you're a licensing entity, you basically have to look at the available market, the addressable market, who's going to take a license, who's going to turn away from you, and you basically do a discounted cash flow. I will try to publish this presentation as a document. I'll try to put a discounted cash flow financial model in it. But right now, it's basically what it is. Many of you have done it. Or if you have a financial wing in your institution, they know how to do it. And they basically use this for many different licensing or alternative monetization. You could use it for litigation. This is a very long-term prospect, and it's risky, but the rewards are tremendous. You could do a catch and release. So there's all kind of, for example, tax benefits. If you never own it, you just catch and release the portfolio. This is a technique that has come about in the recent decade. But just release the portfolio before you own it. Could spin it out. So basically what you do here is take it to 5 people. 2 of them take a license to it. That's fine. Now you could spin out the right to license the other 3 for a different organization. So basically you could do all kind of transactions on it. You could sell the license and sell the right to license or litigate to others. Obviously, those who took a license are safe. And you could use any combination of the above. So basically, I know many entities that do a bunch of these. So you do have to build a financial model, and there are many factors that enter into your financial model. Again, one of the biggest factors is the technology feature that's covered by the claim language. Is it core or peripheral? An example is, like I said, flash memory or battery, as opposed to an app. For example, an app that comes out of the box with the portfolio, it's still a good case, but it's really peripheral. It's not core to the mobile device. Then you look into what percentage of that technology does this patent cover. For example, if there are 10 different technologies in a battery, you may be covering only one of them. And this basically gives a factor of 1/10 into your valuation. There are other factors here, in effect, like there may be like 100 patents for each one of these technologies. People who are in this business, they know, for example, a cell phone is covered by nearly 100,000 patents. There's 100,000 live patents that read on a mobile device, believe it or not. Some even say 250,000. Then the next factor that comes into effect, what percentage of the value of the device does that technology present? It's highly disputed. For example, if you go to a cell phone manufacturer and you have patent on the manufacturing process, they'll say, okay, you sell this device for $700. But they say, oh no, it costs me $7 to manufacture it. And I don't know how many of you have looked into the supply chain of an iPhone. That's how much Apple pays Foxconn to build an iPhone. $7. Of course, they have to source the LCD, the battery, but putting all together, it costs them $7. So it says, okay, it is $7, not $700. So this is the largest one point of discussion between a licensee and a licensor. And then there's the issue of indemnification. They'll say, okay, we're indemnified. And I'll explain when that argument is justified. For example, you may say that the battery itself is considered to be 5% of the value of the device. So you have a factor of 1/10. Now you have the factor of 0.05. You have to multiply these two factors. And remember, you had 100 patents, so you have to multiply by 100. So it's really, as it becomes smaller and smaller. Then, okay, how much do you apply these factors? For example, you end up with 1 in 100,000. What is the royalty stack? So a reasonable assumption about the royalty stack is 25% of the net profit, or about 5%, maximum 10% more on the 5% of the revenue. People like the revenue rather than profit, because the profit calculations could be shady. So you could do like 5% of the revenue. Many licensors, like I said, prefer to take into account the cost of device, but many licensees don't like that. Another big factor here is how much life is left on the patent. So basically, if you have a patent on its third or fifth year, you're in good shape. If you have a patent on its 17th year, you could do maybe 3 years of licensing. So that is a huge factor, and that comes into discount rate. So the discount rate basically, so you can calculate it for 3 years only. And the discount rate is really is the future risks that you have to take into account. Basically, it tells you that the laws may change, the damages model in courts may change, and I put a 15% discount value. And this is another thing that's highly contested between a licensor and a license fee, especially in biotech. That somebody may, for example, invent a new drug, and that really chips away from the future value. Here are some of the risk factors that you could all apply to the discount factor or the discount rate. These include discounts on the price itself or the discount rate, which chips away from the future value. One is definitely validity or expiration. In this case, the validity is nowadays is a statutory subject matter risks that everybody is aware of. And this has heavily weighed on discount factors in recent portfolio sales. What is portfolio size? So large portfolios are much less risky than small portfolios. So if you have a large portfolio, especially one with many open apps, people really like it. So open apps, everybody thinks they're going to prosecute them better than you do. So, and they feel some freedom how to basically steer the portfolio the way they want. Heavily encumbered portfolios, that means they're licensed to many parties. They're very difficult to license. The rest of the market is disparate normally. It's very fragmented. And that's normally the motivation behind selling them. And prior art has always been a factor. But open apps, again, helps with this risk. And indemnification, they come and say, oh, we are indemnified because our battery comes from such and such company, and they indemnify it. And the question is the battery off the shelf or is it bespoke? Meaning that they bought it off the shelf or they were designed to demand. In many of these cases, all these components are designed to demand. So the indemnification argument from the licensor becomes weak. So one way to think about all these risks is this Vann's diagram. It basically, if you have novelty infringement and prior art intersecting, this golden star is where you want to be. So you want to be novel, you want to be infringed, and you want to steer away from prior art. That's where we're looking at. However, other circles have come about in recent years. Normally, these circles would coincide, but excuse me. Broadest reasonable interpretation could get you in hot water. Alice is a huge factor. So basically, you want to steer away from all these pitfalls. Let me talk a little bit about future value. It's very difficult if you have an application or a patent that's not being used now. So how could you evaluate it? The thing is, it's very risky, but the reward could be very, very satisfactory too. Such portfolios could really be picked up cheap. And they may actually, if you're buying a lot of patents, it's a good idea. And there are two types of risk that I'll explain. One is market risk. One example of market risk is that you won't have a market in the future. You may not have a market. One thing is chatbots, one example, and everybody's getting into chatbots, including Facebook's Messenger. And they're all inspired from WeChat of China. People buy plane tickets, they do all kinds of businesses on WeChat, but it may be a cultural thing. And it may never come, for example, to US and Europe. The other type of risk is technology risk, and that's, okay, the market, in this case, the market exists. We know there is a market for this technology, but this technology, this particular technology may not win. So this is another risk. For example, one resistive memory versus phase change memory. I personally would buy both of them. I know big companies are behind either of those two, so it's a good risk to take for my money if it's a technology risk. But because memory will always be in demand. Here on the next slide, I'll show how to do a discount factor or discount rate. If you have technology risk, horizontal axis, and market risk on the vertical axis, your discount should be slanted towards the vertical. Basically, down here in green, that's where you want to be. That's current value. You have no market risk, no technology risk. Up here, you have technology risk. It's a good risk. Take it. Here, there is no market risk. But be careful. For example, RNA epigenetics has no market right now. But if somebody were to come up with a good RNA epigenetics market, all the cancer patients will come to that device. So it's, even though right now there is no market because a good solution does not exist. And here is an area that you really need to avoid: high market risk and high technology risk. A little bit about standard essential patents. And friend, these patents traditionally have been highly valuable. However, recently they have been compromised by fair and reasonable royalty settings. But I'll give to you an order of ascending order of how valuable these patents are. So the bottom of the chain is if the patent belongs to a sitting member of the standards committee and it is declared into the standard, that's really gets hit by the friend and can't do much with that patent. Next in the value chain is it did belong to a member, but it was not declared. So here you do have a little bit of leverage, but they're all kind of contesting about these patents, that why you didn't declare it. A better scenario is it does belong to a member with a priority date before the committee was sitting. So here you have much more leverage. And better than all of these is if the standard essential patent doesn't belong to a member, so belongs to a non-member. And the best scenario, it does belong to a non-member with a priority date before the committee was sitting. So if you are after standard essential patents and you want to evaluate them, this number 5 is what you're really looking to get. That's the best scenario for a standard essential. Then there is the category of standard plus feature. Those could also escape the FRAND obligation. One example of this is a medical device that uses, for example, Wi-Fi or Bluetooth, any of these standards, but the medical feature of it is extra to the standard. So you have standard plus feature. So these are also valuable patents. You could cross-calibrate all these valuation methods. You could, for example, use market-based data to fine-tune and recalibrate your income-based models. For example, you have an income-based model, and you do all kind of factors and coefficients, and you do a couple of these, then you go do a sanity check with the transactions in the market, and you come back and tweak those factors. So market-based data, for especially small portfolio, one thing that it does do is helps you with your calculation of income-based financial model. You could calibrate current value with future value. For example, if you have a good current value battery or flash memory or a social network that you know it's being used and it has this much value, now somebody brings you a future value for memories or for processors that you don't know if this technology will win and will be adopted, but you'll use your current value, a portfolio that was sold and was being used or licensed, and you use that as a base on estimating your future value, and you apply your discount factors and discount rates relevant to the failure of that future value portfolio. And this is the example that I just gave. You could use competing technologies against each other. So you have one technology, one product, and two different technologies. If you have one future value portfolio, you could basically benchmark it against a different technology portfolio. And emerging technologies for different fields could be used. For example, AI, if you have something in artificial intelligence, and you have something in analytics or in autonomous cars, these are both emerging technologies. There's no technology risk, and you could benchmark these portfolios against each other. There are all kind of checks and balances that you could do. We talked about patent portfolio being an essential assets for all kind of entities, including small entities and larger entities. It's crucial in many business transactions and functions. And there are three ways to evaluate them. It's a cost base, which gives you the 50K rule. And we discussed market base. works well for large portfolios, but we presented some techniques that we could use for smaller portfolios. And there is the income-based, which is the most popular and it's most used. So hope you enjoyed this presentation. Current and future value and risk, definitely talked about those. If you are about 50 minutes in, you could take some questions. Before we do, I could show you that you could go to this link and download this presentation. And if you sign up at GHB Intellect, we're doing a transcript of this presentation into a expanded document with one discounted cash flow model, and we'll have those. If you sign up there, we probably could share it with you. And also, for in the future, we'll in the next few days we could email it to all the IIPLA members who wish to contact IIPLA. And thank you for listening. We'll take a few questions now.
Thank you, Dr. Vakili. That was great.
You're coming a little weak, Lawat. Could you?
Sorry. Thank you for the presentation. We have 10 minutes if there's any questions. I haven't received anything so far, but we'll wait for a couple minutes. If there is none, then we can close the webinar.
No, the volume is still a little weak. So okay, so we're. Basically, these with other services, this is something that we do present at GHB Intellect if you're interested. And you're involved in any of these M&As, IPOs, development of portfolios, definitely could help you. We hope to put this presentation together in the Brussels meeting of the IIPLA. I see one question coming in. Yeah, so the question is for engineering and new technologies, what kind of valuation would you use? For emerging technologies, you use the income model. You could estimate the size of the market and the available and addressable market that product would go into. The markets are the size of the markets are available through many entities like Piper Jeffrey, for example, and you could get those. Then you do your all those coefficients that we talked about, and you basically build a model. We could definitely help you with that too. What do you think of the automated evaluation by software like patents app? So, like I said, you have two similar patents one of them will be invalid. So it's really risky. I would recommend against using any automated software valuation. What they do well, the software valuations, what they do well in doing, for example, Relicura does a very good job in semantic search, landscaping, and citation analysis, but really to put a money on a patent, you do need a valuation model. Okay, Mr. Park, hope that, and Ross, hope that answers your question. Mr. Ali Al-Mazani, thank you. Next is from Brenda. How does a small startup know if they are getting a good deal regarding the value of their patent portfolio? Who can they hire if they do not have money to hire someone like yourself? Are these resources? So, very good question. You're a startup, you want to know the value of your portfolio, but you don't want to spend a lot of money. You do have the option to get an initial opinion, and there are many services, including us, who would, if you want to sell your patent portfolio, they do it on commission. So, for example, we'll go and shop and try to sell your portfolio. We'll do all the marketing, and at the end of the day, there is a percentage of the sale that we'll take, and it won't cost you anything, pretty much. So that's what you can do. Next question is from Milena Higgins, and she's asking, what market data sources do you use? So there are many. Gartner is one. Piper Jeffrey is one that I use. You have to subscribe to these, but there are many of these also available from sources like Yahoo Finance. If you don't want to subscribe, you don't want to get a seat on these, just go and check. You could check revenues. You could check total market cap. Now, to dig deeper into a single product of those companies, that's a little tricky. That's, for example, you do Hewlett-Packard Enterprise, not Enterprise, Hewlett-Packard company does produce laptops, tablets, but they also have servers. The server market is about $50 billion total. How much of it does HP own? How much of it is owned by, for example, Dell? You could get these from such services. But the $50 billion, you could definitely get it off of a Google search or of Yahoo Finance. Hope that answers your question. We could also help. We do subscribe to those financial services, so we do have those. Very good questions. I think that was the last question. There are many other ones. Thank you, Mr. Park. And Matt is asking, Matt Noble is asking, what do you think of using patent bibliological information to value patent? For example, forward citation. That's a very good handle. Forward citations are definitely a very good handle. Sorry about that. It's a very good handle, but here's the thing. There are many patents that have excellent citations, like hundreds, thousands of citations, but they don't have good claim language. They have divided infringement, for example, or their claim language is too narrow. Basically, nobody infringes on it. So yes, you could use it. For example, if you're mining the Nokia portfolio, there are 12,000 patents. You could definitely use citation analysis to pick out maybe the top few hundred, but from there on, you really need a claim analysis. You need technical analysis, you need legal analysis, you need financial analysis on top of that. And part of that is claim language, validity analysis, so you do have to do one. So it's a good handle, but it won't give you a value. Hassan Al-Mazana is asking how currency rate exchange can affect the value. Hassan, most every business transaction that I've seen is in US dollars, so you're really looking into US dollars. Even in big, like in Japan or in Europe, people really do this transaction to US dollar, but the currency exchange should not have any effect. If you do a valuation in US dollars, you should have it in other currencies as well. Thank you, Matt. So that was our last question. Thank you, everybody. Like I said, the link is there. If you have any questions, don't hesitate. That's my email, masoud@ghbintellect.com. Just send me a question. I won't charge you. And be glad to talk to you, and hope to see you all in Brussels in the European Summit of IIPLA. Thanks, everyone. And with that, we'll sign off.